for many, many years, and I'm thrilled to be able to do this. As I was telling Savannah, the libraries are really important to me. And even though I am not, and my office is not in Downers Grove anymore, one of the things that I want to tell you is that I sold my house, as many of you know, in Downers Grove after my husband passed away. And so the office is in Chicago, but my office manager named Beth Austin lives in Woodridge, and she comes in every day and picks up tax returns and delivers tax returns and works with clients. So we try to do the very best we can. And we do. We seem to be very busy. Before I start, I want to tell you a little bit about what's going on with the IRS. And this will not be political, this will be honest, because I think both you and I need to understand what's happened. Probably the very first thing that happened is there are 35% less people at the IRS than at exactly this time last year. What that means is that any kind of interaction that you and I can have with the IRS is going to take forever. Even when I call them on my practitioner priority line, I can be on hold for 2 hours, or I can be told that they're too busy and I need to call back later. So that processing things, getting things done, anything that's not electronic is a major problem for the IRS. And that is true on a regular basis. Number two, and this is very important for you to hear, the IRS will not send out any refunds by check. They do not want anything in paper because they don't have the manpower to deal with it. And in many cases, they lose it. What that means for you and me is that if you're getting a refund and it isn't direct deposited into your bank checking account, they will send you a letter and tell you that it has to be. So that, again, most tax returns, they don't want any tax returns in paper. They want them all what we call electronically filed. I'm required to electronically file all the tax returns, okay, as an enrolled agent. And they don't want any tax returns in paper. So when they're electronically filed, you can check online, and almost everything that's done by the IRS, whether it's done well or not, and I'm telling you, in many cases, it's not done well, but you can check when your refund is coming online. So that if somebody like me or somebody else that's a professional is doing your tax return, we get an acknowledgement that the tax return has been accepted, and then we call you and we tell you that your tax return has been accepted. And then we tell you how you can check online for your refund. So that's one thing that's online. The second thing that's online, and we are telling all of our clients, and I'm telling all of you that you need to do that. Many of our older clients are now paying taxes quarterly called estimated taxes. When you were working, you had tax withheld from your W-2 form or from your wages, but often when you are retired, money is coming in from many different places. It's coming in from Social Security, it's coming in from pensions, it's coming in from investments, it's coming in from annuities. And so in many cases, and it's coming in from IRAs, in many cases, you're not having enough tax withheld to cover your tax liability, and the IRS requires you to pay 90% of the tax due during the calendar year. The IRS does not want any estimated taxes in checks either. There is a way, and we tell our clients and show them exactly how they have to pay their estimated taxes online. You can do that for the IRS. You can also do it for Illinois. It makes it so much better to pay them online and then also to track them so that we're sure that one, they're paid, and two, they're paid on time. I had somebody about a month ago before the end of the year, and I happened to just was looking at their end of the year tax situation, and I discovered, because I can check Illinois, that they didn't pay their third quarter estimated. And I said to her husband, I said, could you check with your wife? And he sent me back an email and he said, oh my God, she forgot to pay it. But again, part of the issue is that you need to make sure that everything is paid and that everything is paid on time. Because if things are paid late, or like this client now had to double up, you will get a penalty if you haven't paid in equal to last year or 90% of the taxes due. When you hear what I have to say to you, you'll know that that becomes a little bit tricky to figure out. Number three, before I start, is that, and this is a very important thing for many of you and also for whoever does your taxes to realize, that when I started, everybody got their tax refunds in checks. We used to run to the mailbox. We also used to get all of our tax forms by mail. They came. Our W-2s came by mail. Our 1099s from our interest came by mail. Our 1099s from our investment accounts came by mail. Our retirement 1099s came by mail. Social Security 1099s came by mail. You know what's happening now? If you look at either your phone or your computer, you will notice either a bank or Fidelity, Vanguard, or a mutual fund company, they want you to get all of your statements and your tax forms online. Okay? And so many people, even our clients, we send out checkoff lists, they're missing things because they forget to check online. You have to check online, you have to download them. I strongly recommend that you print them, because otherwise you think you've got all your documents and you've only printed some of the pages. I tell you to print them all and then either paper clip them or staple them together so you're sure you have everything. This is a major problem for those of us that like to work in paper. I like to work in paper. I tell my clients to make sure you have all of your original documents, because if you don't and you're missing stuff when you file, you will absolutely get a letter from the IRS. So that's one of the other things that's really critical. Before I go any further and tell you some of the changes, I don't think I see any questions, but I want to know what questions you have, because I can talk for an hour, I can talk for 2 hours, but I really want to hear what questions you have. Is there anybody that has a question on the Q&A that I see? I see no questions yet. Do we have any questions that anybody has for me?
Yeah, feel free to use the Q&A feature if there are any questions. I can help moderate that as well.
Well, I don't see any yet. So I tell you what, as I go through this, I really want you to put questions in your Q&A. And if you have a question that's not specific to you, but is a more general question, I would ask you can call us tomorrow. I'm here tomorrow. I'm here and Beth is here. Our phone number is still 630-964-4018. And believe it or not, probably at least 60 or 70 or 80%, I will pick up the phone and say hello. So the very first thing I want to tell you is that the tax rates, and we still have, and this is not, again, not political. Somebody has a question. Let me see what it is. Hold on. Okay, I will answer the question at the end when we talk about this. That's fine. The tax rates that were put in 2017, when Trump was president before, are still in effect. They are lower tax rates than they have been before. In all the years I've been doing taxes, these by far are the lower tax rates that we've ever seen. In 2017, they did something else, which was real important and is still in existence. They increased the standard deduction and they got rid of all the exemptions. We used to have a standard deduction and then an exemption for each one of us and an extra exemption when we were over 65. Now what we have is a larger standard deduction and an extra standard deduction when you are over 65. Okay, that's pretty important. It is an extra standard deduction. It's $31,500 for couples, $15,750 for singles, and an extra $2,000 if you're over 65 and single, and $1,600 a person if you're married jointly and over 65. So the standard deduction is really quite large. I'm going to talk about itemized deductions in a little bit, but keep the standard deduction in mind. There's also something else that's brand new from the tax bill that was passed in July of 2025. It's called a senior bonus deduction. It is an extra $66,000 for each person that's 65 years and older. So for a married couple, that's $12,000. It's a lot of money. But there's a kick. What's the kick? Everything that comes and is a bonus has an income phase out. And the income phase outs aren't that high. The income phase out for the bonus starts at $75,000 for singles and $150,000 for married joint. Okay, so it doesn't just go away completely, it phases out, and there is a new worksheet for the single deduction. And it's kind of tricky to figure out. Okay, and that will be in, okay, for the next 4 years as long as Trump is president. But that senior deduction is there. I figured out for a client that I was just beginning to work on now, it saved him about $800 in taxes. So it is a tax savings for many, many people. Now, the second thing that happened, and this is very important, I mentioned itemized deductions. When they changed the law and they increased the standard deduction to be really almost double, most people didn't itemize. And part of the reason that happened was because there's a section in itemized deductions that's called state and local income taxes. It includes your Illinois income tax or your sales tax. It includes your real estate taxes on your house. It includes your mortgage interest. It includes your contributions. It also includes medical, which I'll talk about in a little bit. And so, again, most people didn't itemize. They limited what was called SALT tax, which is the state and local income taxes, to $10,000. So to give you an example, I have a lovely client of clients in Woodridge and Downers Grove in the western suburbs. Now I have them all over the country in Colorado and California and Florida and Kentucky and Tennessee. But anyway, they limited the state and local income taxes to $10,000. My client in Oak Park, and I do have some clients in the city, mostly not where we are, he has real estate taxes that are 26,000. Most of us don't have that. They were limited to 10. It really, really hurt him. They made that SALT section, the state and local income taxes, now $40,000. So can my client take all 26,000 of his real estate taxes? He can. Will he be itemizing in 2025? He will. And so a lot of people more are going to be itemizing in 2025 because of the change in the SALT tax than did before. But again, we have to work your taxes this way and then also this way to see whether you're going to itemize or you're not going to itemize. And we don't know until you bring us all the stuff. Some people also have more than one house. They have a house in Woodridge and they might have a condominium in Florida. So they might have two batches of real estate taxes. They might also have mortgage interest or not. But again, it's really important to see where that number floats through. Okay? And so that changed a lot in 2020 for 2025. And that's going to be a really big change. The other thing that didn't change, but I really want to mention right here that's critical, is a lot of people, when there wasn't any deduction for state and local income taxes, they didn't bother to figure out their medical expenses. Okay? And I strongly recommend that you figure out what your medical expenses are for a couple of reasons. Probably the first one is a non-tax reason. And that's because many of us are paying a lot more for our medical expenses than we used to. Medical expenses include the following items. Okay? It includes your deduction from your Social Security for Medicare. It includes the deduction from your Social Security for your drug insurance. It includes your out-of-pocket expenses for your supplemental insurance for Medicare and for your drug insurance, however much that is. And that's for one person, or if you're married, it's for two people. It also includes your long-term care insurance. Now, one of the things I think I noticed, which I didn't love, and I'm sure you've noticed, is that our insurance seems to go up, not this much, but this much. My insurance went up my Blue Cross Blue Shield went up $500 this year. Okay, it's a huge amount of money. Okay, and so not even counting what you've paid out of pocket, you would be surprised how much your medical increases. Medical also includes all of your out-of-pocket expenses. And I'm going to give you a whole list of them. I have them on my checkoff list. If many of you are clients, you would get it in the mail. Okay, it includes drugs, out-of-pocket that you pay for drugs. It includes your deductible that you pay for doctors and your out-of-pocket for doctors. It includes physical therapy. It includes anything you pay for tests out of pocket, anything you pay for hospitals out of pocket. It also includes, I was going to say something else. Let me think about what it was. Hold on, my brain fries sometime. It also includes, I don't remember what I was going to say, but it'll come to me. It includes hearing aids that are not covered by anything. I know what I was going to say. It includes my favorite doctor that I like but don't love, and that's my dentist. Many of us are not young, and the good news is I still have all my teeth. The bad news is I have several implants. Those of you that have been to the dentist and have implants, you know how much they cost. It costs money to take the tooth out. It costs money to put the post in. It costs more money to have a jacket crown put on top of there. I now have 3 of them as of last year, and they're very, very expensive. I had one client that had $30,000 for 2 people in implants. So you would be surprised how much your medical adds up to. On top of that, if you have a walker, if you have a cane, if you have a hospital bed, if you have depends, if you have other kinds of things that are medical supplements required by your doctor, that's all part of medical. The reason I suggest you add it up is people are flabbergasted about how much their medical expenses are as a percentage of their income. It really turns out to be a lot of money. On the flip side, and I need to say that this isn't a tax thing, but I have quite a number of clients that are really freaking out about the cost of medical insurance, and they're doing a couple of things. They're going to Medicare Advantage plans because they're a lot cheaper, okay? But they also have really big deductibles. They also have really big copays, so they're fine if you're healthy. They're also not so good if you're sick. And they limit the hospitals and the doctors you can go to. And sometimes you can't get in to the doctor that you really want to see. I have a client that didn't get in for brain cancer surgery for 3 months. Thank God he's all right now, but he couldn't get to the doctor that he wanted to get. So the medical is very expensive, and at least you want to look at it and see what your costs are. The other part of medical, and I need to say this because it's tricky, is that some people have care in the house. Some people are living in retirement facilities, and some of them are in independent living, some of them are in assisted living, and some of them are in memory care. If you buy in to the retirement community like Beacon Hill and Lombard, there is a huge cost of the buy-in, and a big percentage of that is a deductible medical expense. Depending on the level of care you're at, a percentage of your monthly bill is also deductible as medical. The retirement homes send out a letter in January telling you, and then you tell us how much of that is deductible. So often you're paying a huge amount for that, and you might be able then to itemize your deductions and deduct your medical expenses. But I suggest strongly that you look at the medical expenses to figure them out. Okay, so that's really big for 2000. It's been going on, but I think we're going to see a lot more people itemizing their deductions in 2025 than I have seen in past years. Okay, the next thing that's happening that I really want to talk about has to do with IRAs. IRAs are retirement account, individual retirement accounts. It's retirement income, and it's income from either an IRA or from what's called a 401k or a 403b. A 401k is if you work for a company. A 403b is if you work for a nonprofit. Like I have a 403b that came from Benedictine and from George Williams College. After you turn 73, it went up to 73. It was 70 and a half when I started taking it, and then it was 71, and now it's 73. You have to take out a required minimum distribution. You can't leave it in there. The way that RMD, retired minimum distribution, is figured is the following. It is based upon the value of all of your retirement accounts, not including Roth, at the end of the year. So you have to look at your statement from 12/31/2025 and add them all together. Then the IRS has what's called a table, a life expectancy table, and you take the value of all your IRAs and divide them by the life expectancy table, and that's the money that you are required to take out. And every year, hopefully every year, that money grows more, and unfortunately, we get older. So you have to take out more money every single year, usually than you did the year before, unless you have it in a bank. Okay, the stock market is done very well. That money is required to be distributed. One of the things that happens to my clients is, their income is relatively lower, and then they start taking out RMDs, and their income jumps up a lot. We'll talk about what happens when their income jumps up a lot, but you need to make sure you take out your required minimum distribution. You can take it out of any one of your retirement accounts. You don't have to take out a little bit out of each one. You can take it out if you have one in a bank and it's not earning very much money and you want to get rid of that one first, then you can take the RMD out of that one. It doesn't matter which one you take it out. There is, and I will tell you, there are some of us that forget. I have a client that called 2 days ago and she said, mea culpa. I forgot to take out half of it. What can I do? And I said, take it out right away. There used to be a huge penalty of 50% of the required withdrawal. They've now reduced that penalty, if you correct it, to 10% of the required withdrawal, as long as you fix it within 2 years. Now, having said that, I have never, ever, ever seen the IRS enforce that penalty. Okay, because I tell them, which I've never had to do, hey, look, we found out that they forgot, and then we took it out right away. So you got your tax anyway. You just got it a year late. But I've never had them do it. But you need to make sure that you figure out your RMD and figure it out correctly. If you're a client of ours, we send you hot little pink reminder postcards to tell you to take out your RMD so that you really don't forget. And if you're turning 73, then we remind you that this is your first year and you have to do it. It's not so easy. Now, there is another part of this RMD that people are getting caught about a lot. So let's assume you're married and your husband dies or your wife dies and they have an IRA and you are the beneficiary of their IRA. If you are a spouse, what is called a surviving spouse, you can take it out a little bit at a time, just like I just told you you could do if it was your IRA. So you can do what we call a stretch IRA. If you're not a surviving spouse, you're a child, you're a sister, whoever you are, and you inherit an IRA, you have a problem. The IRA has to be completely liquidated by the 10th year. You can't wait until the 10th year to take it out. You have to start taking it out ratably every single year. Okay? So I have yet another client, and last year I told her sister died. It's her twin sister. They actually grew up in Downers Grove. And I told her to take out $50,000 out of her sister's IRA. She took it out of the investment account instead of out of her sister's IRA. We're into year 5. There's still $300,000 in her sister's IRA. Figure out how much she has to take out for the next 5 years, almost 60,000 to get it completely liquidated. It's going to cream her tax return. It's going to cream her tax return. But the IRAs have to be liquidated, and they have to be ratably liquidated over 10 years. You can't wait. The IRS wants the money. And this is a very important thing. If somebody dies, the IRA becomes, if you look at the form you get from the IRS or from your Fidelity or Vanguard or Edward Jones, wherever you have your money, it's called a 1099-R. R stands for retirement, okay? And that form has a code. If it's my retirement, it has a code 7. If it's an inherited account with a retirement, it has a code 4 for somebody's death. Okay? Now, if you have Roth IRAs, you don't have to take them out at all. But if you don't have Roth IRAs, you have to take out a required minimum distribution out of the IRA each and every single year. Does that screw up your tax return and could put you in a much higher tax bracket? Indeed, it does. Indeed, it does. So what can you do to reduce your taxes once you're taking out an RMD? Well, there's a thing that started in 2017. Everything has an acronym, and this is called a QCD. A QCD is a qualified charitable distribution. And what does that mean? It means that instead of taking all the money out of your IRA and putting it in your bank account or in your investment account, you can say, as I have done, I want to give $1,000 to the Woodridge Library. I want to give $1,000 to the Salvation Army. I want to give $1,000 to the Food Depository in Chicago. I want to give $1,000, I don't know, to the DuPage Symphony, whatever charity you think you want to give to that is a charity, what's called a 501c3 charity, because I told you most people aren't donated. That also includes your church, okay? St. Scholastica and Woodridge and other churches. So what you have to do with the QCD, and this is important, the money can't go from the IRA to you. It has to go directly from the IRA trustee to the charity, okay? And that counts as what's called a qualified charitable distribution. When you or I do your taxes, there is a little place on the form, that's the 1099-R form on my computer. There's a little box that says QCD. And I open it up and I say, okay, we're going to subtract $1,000 to the Woodridge Library. We're going to subtract $3,000 to St. Scholastica. We're going to subtract $2,000 to the Salvation Army. On your 1040, then, on the line for IRAs, to the left of the gross amount, it'll say QCD, and on the right amount, where the taxable income shows, the amount will be the gross amount minus what you gave away in QCDs. And again, because most people didn't itemize, a really big way of saving tax money is to give qualified charitable distributions. But you can't have the check yourself. You have to have it sent from the trustee. Now, one of the things that happened when this law changed was this. If you go to church, okay, you were used to having the basket passed around every Sunday, and you put an envelope in or you put cash in, and they sent you a letter at the end of the year and they told you how much you gave them as a total. Now churches, and for quite a number of years now, have been getting used to not getting money every Sunday. They're getting a big batch once or twice a year from these qualified charitable donations. And it works really well. And what I do and what you can do is I figure out somebody's taxes with the QCD and without the QCD, and then I tell them how much they save by using this qualified charitable deduction. It's really a very big thing. And so it's important. This is one of the biggest tax saving things to do. Now, one of the other things with these IRAs that I want to tell you is, and I mentioned it before, what your RMD is based on is the value of your IRA at the end of the year. And it's both a good thing and a bad thing. The bad thing is you're paying more taxes. The good news is that the stock market has done incredibly well. And so if you look at the value of all of your retirement accounts, they're substantially more than they were last year, than they were the year before, and even the year before that. I'm hoping the market doesn't crash, but we don't have any idea what's going to happen with the market. But that's what's going on with IRAs, and that is really, really big. Okay? Again, we make sure, I'm really careful, so you know, we do the taxes on my program. I have a professional program. Some of you use TurboTax and it works. Okay? But my program costs $2,500, so it's slightly more sophisticated. And I always make a list of everybody's qualified charitable distributions so that if we ever get questioned or if the IRA wants to look at them, you have them and I have them, and I ask to make sure that you bring them to us. Okay? So that's one of the things that's really big. Okay? And it reduces, I'll talk about something else related to Medicare in a few minutes, but I also want to talk about something else related to Social Security and Medicare. So here's what's going on with Social Security. We all get Social Security. Some of us get it at 62. Some of us get it at 66 and 67. Some of us decide we're really going to wait until we're 70. I usually go through it with people and help them make decisions on when they're going to get it. Okay? And the law from Social Security has really not changed since 1992. And you need to hear this law because it's really important. Again, each one of these things is changing how much your income is. So what happened in 1982, okay, they really had a recession and they really needed more money. And they didn't want to raise the tax rates. So what did they do? This was under the Reagan administration. They decided that if people had higher incomes, quote unquote, they would make at least 50% of your Social Security income taxable. And in 1992, there was the same problem. And so they made up to 85% of your Social Security taxable. So now, if you're married and half of your Social Security and the rest of your income is above 44,000, 85% of your Social Security is taxable. If you're single and half of your Social Security and the rest of your income is above 34,000, then 85% of your Social Security is taxable. It is a big boondoggle. They have never changed it. They didn't change it in 2025 when they passed the law. Okay. And what's happened is that most of us have more money than we used to have. And I would bet 60 or 70 or 80% of the people getting Social Security are paying tax on their Social Security. So to me, as both a taxpayer, a tax preparer, and somebody who gets angry, I worked my whole life to collect my Social Security. When I was earning it, it was part of my salary. I paid tax on it then, and now I'm paying tax on it again. But again, they have not changed the law. So it is a major problem. Something else that's going on, and I need to tell you this, and I don't know whether you looked at it or you didn't, but Social Security goes up every year and it's based upon some inflation number. So a couple of years ago, Social Security went up 6 or 8%, and Medicare went up this much. This year, Social Security went up 2.5%, and Medicare went up 5%. So you know what happens? We got more Social Security, but we're getting less in our bank accounts. And so the Social Security becomes a really interesting big problem. So when people start collecting Social Security, then again, their income goes up. And we'll look at what happens when your income goes up in a few minutes. I'm going to talk about one other thing that happened with Social Security. And I really want you to listen to this because I think this is both a blessing and a curse. And this happened before, at the very end of the Biden administration. And many people don't even realize that it happened. Okay? What happened is the following. Most of the people that have been teachers or government workers had what we call a Social Security offset. So if they got a pension from a government agency, including the state of Illinois as a teacher, they got less Social Security, or their spouse got less Social Security. In January of 2024, under the Biden administration, they passed what's called the Social Security Fairness Act to make up for this inconsistency and this unfairness to those groups of people that I talked about. Many, 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 many people got the following. They got their small amount of Social Security in January and February, based upon what they got before. In March of 2000, and Social Security, just like everything else, shows up in your bank account. They're not sending checks. It shows up in your bank account. I love it. It shows up the third Wednesday of every month, and I say, hallelujah. Okay? Most people don't even look to see that it shows up. Younger, okay? In March, many, many, many people got a lump sum of back Social Security. I have somebody whose husband died, and she was the librarian. She got $24,000 in her bank account. It just sort of showed up serendipitously. She didn't know why until she read my newsletter. Okay? And then starting in April, Social Security increased to a very different level. It was substantially higher than it ever was before. So when you get your Social Security 1099, you look at this number and you say, where in heaven's name did all that money go? I didn't get it. And then I tell people to go back and look at their bank statements. Again, and some of this is us and some of it isn't. It's surely my younger clients. They don't balance their checkbooks. They don't even look at their bank statements. Their bank statements show up online. They never download them. We'll talk about identity in a little bit, but I check my bank every day to make sure that things are okay and to make sure that I balance my checkbook. Many people do not. I have clients and I think many people are going to be surprised when they look at their Social Security 1099 and they say, where did all that money come from? I didn't think I felt any richer than I ever felt before. And lo and behold, that's where it came from. It came from Biden's Social Security Fairness Act, which they haven't changed. Okay? but I have to tell you, it's huge. Okay, it will be on your Social Security 1099, and it, for 2026, you're not going to get a lump sum, but you're going to get a bigger amount every year. And when we were talking about estimated taxes just a little bit ago, it has to be figured in so that we know how much we have to pay the IRS, considering probably 85% of it is going to be taxable. So this Social Security bit is a huge, huge difference. Okay? That's something that's really very tricky. Something else that's a corollary or that happens with this is something else. And wait a minute, before I get there, I want to say something else. There are two other things that probably have happened in 2025 that happened in 2024 and may happen again. The first one is that maybe in 2021 and even in 22, most of us had money in banks, in savings accounts, and we earned this much money, maybe a percentage, maybe 2%. Starting in about 2023, the interest rates jumped. And so I had clients that had huge amounts of money in the bank, and now we're getting 5% in interest. And they wondered what happened to their tax return because all of a sudden they had this much interest and now they had this much interest. Even treasury bills were paying 4 and 5%. And so it was really funny that they didn't expect it. And so it really screwed up their tax return. The other thing that screwed up their tax return was this, and this is by far a problem from an investment point of view. Most of us have investments. Maybe we look at our monthly forms, maybe we don't. We mostly have mutual funds. We have them in Morgan Stanley, we have them in Edward Jones, we have them in Merrill Lynch. Okay, we have them in American funds, wherever we have them. Those mutual funds throw off interest, they throw off dividends, they throw off qualified dividends from stock, and then they throw off something else that you have absolutely no control over. They throw off what we call long-term capital gains. What that means is this. If I own a stock, and let's say I bought Apple over here, and then I decide for whatever reason I'm going to sell Apple stock, the difference between what I sold it for and what I paid for it is considered a long-term capital gain. It's taxed at a lower tax rate. I have control about when I bought it, and I have control about when I sell it. If you have a mutual fund, you have control about when you sell the mutual fund, but you have zero control about what the fund manager is doing inside that mutual fund. And so you get a thing on your year-end statement or on your 1099 that is called long-term capital gains. That's the money of your share of what the fund manager sold during the tax year. Okay? Sometimes it's nothing. And sometimes I've had clients that have had $20,000 and $30,000 in capital gains from mutual funds. They think the stock market is going to go down, or people take their money out of mutual funds when they thought the stock market was going to tank, and they had to sell things. It really screws up your tax return. And so you never know what's going to happen until you get your 1099 or you look at your mutual fund. There are some mutual fund companies like Vanguard, and I don't sell any mutual funds. I just help people look at things, and their mutual funds tend to be better tax managed than other mutual fund companies. And so they don't have as many problems. I have my money managed by somebody, which some of you do and some of you don't. I don't own any mutual funds. So I don't have that kind of problem. but lots of people do, and it turns out to be a really big surprise. Now, that there are two kinds of things. There's ordinary income, which is interest, and then things like dividends that are in income funds, and they are taxed at regular ordinary income rates. Qualified dividends from stock and long-term capital gains are taxed at a lower rate. That doesn't mean they don't lower your income, they're just taxed at a different rate. But what I find is that people are surprised at how much capital gains flows out of there. Usually that happens in December. It doesn't happen in January, it doesn't happen in February. They usually rebalance things or figure out what they think is going to happen in December, just at the time when you're shopping for Christmas and you're not looking at your online accounts and you have no idea what's going to happen. I have people redo checkups for estimated taxes so that people know what they should pay. When you pay, I'm going to say this again, if you are paying quarterly taxes, you do not have to pay the same amount every single quarter. So you might pay less at the beginning and then pay a much bigger amount at the end when you're catching up and you look and you see there's more income. Now, one of the really crummy problems of this is, and I'll call it crummy, is that you don't have the money in your bank account, but you have it in your investment account. But if you've earned the money, it's counted as income, even if you don't have it in hand and you can't write. I mean, you might be able to write a check on it, but you're not spending it. It's not spendable money, but it's still considered income, even though you haven't taken it out of your investment account. This becomes a major problem for taxes. And I see this with people a lot. They are surprised at how much income there is when they say, I don't have very much money. Where did all this money come from that's on my tax return? Well, God, I don't know. Okay, now I'm going to also flip back before I say something else, because this is the story of somebody that's probably one of the saddest kinds of problems in my life. I happen to have a lot of clients for many, many years, and many of them are older now. So I had this one client, and he came in. I don't think he ever came in with his wife. And he lived in a house in Downers Grove. And he was eligible for something that is called the low income senior freeze on his real estate taxes. His income was this low. Okay. And about 3 or 4 years ago, maybe 3 now, he came in and he hands me a stack of papers and he said, Judi, we need to discuss these. And I said, and what are these? And he said, these are my annuities. Okay. Different than an IRA. An annuity is money that you put post-tax money in, and it grows tax deferred until you either take it out or you have to take it out. They're usually owned by insurance companies and they're sold as a way to avoid taxes. This man was in his early 90s and he was required to take money out of all of his annuities because he was that old now. Okay? How much did he have in annuities? Over $1.5 million. Okay? He had to take out a huge amount of money every single year. And it only happened for 1.5 years because you know what happened to the poor man? He died. So he never got the benefit of all this money because he was avoiding taxes, and then he died. We'll talk about what happens when somebody dies because it's really important to make sure that you have what we call beneficiary done correctly on your IRAs and on your annuities. And it is he has a mess. It is a really big mess. His trust was the beneficiary of some of them. His son was the beneficiary of others. And some of them were the beneficiary. He had a fight with his youngest daughter when she had some emotional problems. And so he made the beneficiary of her share what's called a special needs trust. And now I have a lawyer from him and I have a lawyer from her, and they are fighting with one another about all the money. Okay? So this is a mess. And annuities save tax money, but generally they're not very good investments. And when you have to take them out, they really screw up your tax return. Okay. One of the other things that I want to tell you, and this is sort of tax related, okay? The base rate for Medicare this year was $2,120 per year. It comes out, what comes out of your Social Security, if you look at it, you get your gross Social Security minus your Medicare, minus your drug insurance, and that's what goes in your bank account. That is the lowest level for Medicare. There is a part of Medicare that has a title, it's a funny title, it's called IRMA. It's Income Related Medicare Adjustment. And what that means is the following. It means that Social Security and Medicare check what your income is on your tax return. That doesn't just mean your regular income. It means your full Social Security. It means your tax-free income. And they look at it and they say, oh, your income, and I won't go through the exact numbers, your income is higher than a certain amount. So guess what? We're going to raise your Medicare. And we're not going to raise your Medicare a little. It goes up in 4 or 5 steps. Okay? So if you have these IRAs that are coming out, okay, without QCDs, if you have your annuity that's coming out, if you have an inherited IRA, all of a sudden, lo and behold, if you've got more interest and you have some long-term capital gains, all of a sudden, your Medicare becomes substantially higher. Instead of $190 a month, it might be $300 a month or more. And this is true for your regular Medicare, and it's true for your drug plan also. And it's not just for you, it's if there are 2 of you, it's for each one of you. And it winds up being a fortune. I would tell you in my practice is, I know, it's big enough, but I will tell you probably at least 30 or 40% of my clients are paying more for Medicare. Now, this is a year by year computation because they look at your tax return and then they have an awful way of doing this. They send you a letter in November, just at the time when you're ready to celebrate Thanksgiving and start buying Christmas presents. And they say, guess what? Starting in January of 26, okay, your Social Security is going up this much, but this is how much your Medicare is. So guess what? You're going to wind up with less in your bank account. Okay? And this is called IRMA. It's a year by year comparison. So to give you an example, let's assume that you want to buy a car and you really don't have a lot of regular investments. So you decide you're going to take another $50,000 because that's what car costs, or $40,000 or whatever it is. You're going to take it out of your IRA or your retirement account. Excuse me, not only is it going to screw up your taxes, your Medicare is going to go through the roof. But you don't know that And so one of the things, in fact, I talked to a client today, okay? And we had a question. She needed an extra 15,000. We tried to figure for 2026, we tried to figure out where the best place to take the money out of, okay, for her living expenses and her new medical with her dentist, okay, where it should come out of to manage the tax portion of this. And we talked about selling some stock in her investment account as opposed to taking it from some other place. So again, this IRMA becomes really, really important. Okay? It just, these things, and I will tell you, I love you all. Some of you are better at doing your tax returns than others. But one of the things, if you have a good professional, they look at all these options for you to help you make good investment decisions, to help you make good withdrawal decisions, and help you manage the taxes so that you don't have problems and then you come to me or you put your stuff in TurboTax and say, oh my God, I owe $5,000. Why in H do I owe $5,000? I don't understand it. I don't like it. I don't love it. Where am I going to get the money from? I guess I'm going to have to take it out of my IRA. So part of what doing taxes is helps you do some both tax planning and investment planning. And as I said, it becomes really, really, really tricky. Okay. So I'm going to stop for a minute and see what questions, and then I'm going to go back to some more because I think I see 11 questions. Hold on. All right. So the first question is, for estimated taxes, is it either 2025 paid or 90% of 26? It's either or. Okay? It is really either or. If you paid equal to 25, you won't get a penalty. If you paid 90% of 26, you won't get a penalty. Now, let's talk a little bit about penalties as I go along to this. Penalties are the penalty for you having the money that they should have had. So I don't tell people to get upset about penalties. I will tell you that the IRS, and especially Illinois, doesn't like me to figure penalties because my computer program figures them slightly different than theirs. Often what I do is I figure the penalty and then maybe you get a letter and you get a small refund. But again, I really don't worry too much about penalties. People get hysterical when there are letters, but really that's an easy thing for the IRS to figure out. As I mentioned before, and I'm going to talk about something else with the IRS before we get off here, it's really important to know what you've paid and estimated every single quarter, that you don't make a mistake, and the date that you paid it. If you pay it 1 or 2 days late, it's late. So if I put or you put the wrong numbers in my program, or if I put the wrong dates in my program, then we have a problem because the IRS can easily send a letter and they can check what the correct amounts are and what the correct dates are. What we do for people, we have a worksheet. We give them that and tell them how to pay their estimated taxes online. And I'll talk about how to check them in a minute. But again, if I don't have the correct information, then I get a call or I get an email, or God forbid, I get a text as well. And they say, why am I getting a letter from the IRS? I said, this isn't my error. This is your error. You forgot, or you told me the wrong date, or you paid 2 of them together. Okay, I don't know what to do. All right. Somebody had a question that I see. Are there tax credits for new washers, dryers, stoves, dishwashers? That's a very important question. Okay? Let me go back and find where my notes are. There was for years and years, there was a energy credit, and it was the credit for energy efficient windows, doors, air conditioners, furnaces, solar panels. Okay. And for a while, that credit, there was a max on that credit, and we had to see what was done the year before and keep track of it. And we used to tell people to go online to a website that's called energystar.gov before they bought anything, and then they could make a decision if they wanted to pay more for the Energy Star efficient appliance or not. In 2020, I don't remember which year, it was under the Biden administration, they expanded the energy credits to be really big. They were $1,200 a year, and they weren't limited. You could do that every single year. You can still do that, or if you did that, you can still do it for 2025. You need to go to energystar.gov or look at your receipt for what you bought, okay? And see if it's Energy Star qualified. The form for that is called the 5695. Energy credits are gone. They wiped them out during the new tax law in the middle of 2025. They are gone. There are also credits, which I really don't have time to talk about now. There were big credits for electric vehicles, and there were big credits for other things. Now those things are gone as well. They were gone in September. Okay, so again, those are a problem. There is a new deduction for interest paid on a new car, and it has to be a new car up to $10,000. And that car has to be totally assembled in the United States. So I have to put in the VIN number and all sorts of information to be able to get the deduction for that credit. I hope I don't have very many of those. I really doubt it. Most of us, including me, I have to tell you, you're laughing. I live in the city now. When I lived in the suburbs and I drove back and forth, I drove my car a lot. My car, especially in this weather, sits in my garage. I have a condominium and it sits in my garage. And for example, today it wasn't that cold. I took the bus. Okay, I took the bus, but it really wasn't bad. And so many of us are hanging on to our cars because one, they seem to last longer, and two, cars, you're going to laugh, and I'll say this, and this is the God's honest truth. A car costs more than my first house in Downers Grove, which cost me $42,000. Okay, and most cars cost more than $42,000 now. So most of us are hanging on to our cars way longer than we used to. I get emails all the time from the car dealer that my car is a 2018, and they said, aren't you ready for a new car? Don't you want to sell us your car? We can resell your car and give you really good money for your car. I don't have any intention of selling my car. Okay. All right. I'm looking at other questions. There's a question about FSA. Okay. If you that's a savings account for medical, okay, which is what an FSA is. If you have a pre-tax medical account at work, you are putting in money. Sometimes your employer is matching that money. You will get a form from the company that has your FSA, okay? You can't deduct it as medical, but we do have to show there is a place on the tax return that shows how much you have in there and how much you spent for medical, and that you've used it as a full medical deduction. So yes, that's what happens with that. Okay. So, no, okay, and so that's that. Somebody asked about walkers. For anything that you have, this is correct. For anything, whether it be a hospital bed or a cane or a walker or a CPAP machine, again, it needs to be prescribed by a doctor, just like your caregiver and needs to be prescribed by a doctor. Okay? You do not have to attach a doctor's letter to a tax return, but if you have care in your house, and this gets back to the question that's being asked, if you have care in your house, and I've had some clients do this, if you have an agency, okay, and the reason you're having care is because you can't do 2 out of 5 activities of daily living, okay, then you need to get a doctor's letter that says that, and all of the care that you're paying for to an agency is deductible on your medical expenses as long-term care. Okay? If you decide, which I've had some clients do, that I have a friend and a friend and a friend, and she's really happy to take cash. Okay? Can I count that as a medical expense? Not on your life. I can't count it as a medical expense unless it's considered and somebody counts it as taxable income. I had a client a long time ago, okay, that they had full-time care for the mother and the father, and they were paying a fortune. And I went over there to try and get their social security number to give them what's called a 1099 for the care. He threatened to quit. They decided they were going to give him money in cash. It's about 70 or 80,000. I stopped doing their tax return. I stopped doing their tax return because I wouldn't deduct it as medical. Okay, so that's really important to know. Now, this is also true of the nursing home that I told you. So that when you go into Oak Trace or one of the other nursing homes, there's one in Lisle, I don't remember what it's called now, Devonshire, I think, and there's a really good one in Naperville, or the one in Lombard. They send out letters, and we, depending on the level of care, and so you can do that. But again, it's the level of care. The doctor's letter is only once, and if you've got dementia, they just need to say that. But the 5 things are going to the bathroom by yourself, dressing yourself, feeding yourself, being able to take your own medicine, not being a fall risk. There are about 5 or 6 different things of what we call activities of daily living. But again, and a lot of these things, walkers aren't that expensive. Hearing aids, I have a friend that has hearing aids from Costco, they're cheaper, but a good hearing aid costs $5,000 or $6,000. Somebody several years ago had one year and then came back with more the next year. And I said, what happened to your hearing aids? And they said, oh, the cat ate them. Well, that wasn't great. So they had 2 batches of hearing aids. Okay. So the next question is your RMD taken quarterly all at once? Is it best taken out at the beginning of the year or later on in the year? It doesn't matter at all how you take it out. Some people take out their RMD monthly because they're using it to live on. Some people say, I don't need it, I'll take it out at the end of the year. Other people say, including me, I say, I thought the stock market was going to tank in September, so I took it in July. Okay, so it would be over with and I wouldn't worry about it. It doesn't matter when you take it out, you just need to remember to take it out, and they don't care. Usually the financial people, and I will tell you, some good investment advisors remind you, as I said, we remind you with hot pink postcards. and some don't. It is your responsibility to remember to take it out. But usually, if I'm doing your taxes, we write it on what's called your white folder. We remind you, we put it in our newsletters, and hopefully you remember. Talking about our newsletters, many of you have been coming for many years, I hope. And we used to keep you on our mailing list and send out snail mail newsletters to each one of you and snail mail checkoff lists to each one of you. Our newsletters are now posted on my website, which is www.strausstax.com. Hopefully you're computer savvy. You can download them. They're all there, including the one from the new tax law from July. We're not sending out checkoff lists to anybody but our own clients now. But the newsletters are there so that you can know. Okay. And so if the inherited IRA was from years ago, like 2017, isn't it grandfathered in? I am not 100% sure. I will have to double check with that. I don't think so. I think you have to start taking it out, but I will double check. Okay. Okay, somebody had a question about, am I taking an RMD each year? I assume that that's from an inherited IRA. You're supposed to take it out ratably every single year. You're not supposed to take out a small amount if it's an inherited IRA. You're supposed to take it out ratably and not wait until the 10th year. That's when they changed the law. Okay, you have to take it out every year. Okay, is there a maximum amount for QCD that you can claim on your taxes? It's $100,000. Most of us aren't there. Okay, most of us aren't there. What I do, if you're a client, I run the numbers. If I say, this is how much the QCD is, this is what you'll save in taxes, this is how much the QCD, if you want to do more, you can do more, this is how much you save in taxes. So again, part of the issue might be, if you wanted to wait, you could do more of your QCD when you see what your long-term capital gains are. It's just, it's a really tricky thing, but most people don't give away at all because they need the money to live on. But again, and I want to say this, most of us don't do this, but I want to say this. There is another way of giving, and I see another question about giving here, but there is another way of giving, which I did this year because my husband died 7 years ago, and I wanted to be able to itemize. So there is a way, it's called a charitable gift fund. You can set one up at Vanguard, you can set one up at Fidelity, you can set one up at American Funds, you can put cash in, or you can put stock in. If you put the money in, it counts as a deduction when you put it in, as an itemized deduction. The money sits there and it grows, and when you give it away, it doesn't count as a deduction. So just to give you, and I guess I was really excited that I did this. I have some stock in a regular account, and it's one of these AI stocks. I don't understand AI well. I have a grandson in AI, and it went from here all the way up to here. And I said, oh my God, I think I can give it away. I'm surely not going to sell it. I gave away to my charitable gift fund a huge, I don't know, a big amount of that stock, not a huge, but a big enough amount. Okay. You know what the good news is? It went down 60 points from the time I gave it away and they sold it. So I did a really good job in giving away the stock. So I didn't lose money and I got the tax deduction. But you can set up a charitable gift fund, and it's kind of a nice way if you have the money to itemize. Now, also talking about gifting, which is what the question is, can you gift stocks to your children and what amount? Let me explain how gifts work. What the law says, you can give, if you're single like me, I can give any one person up to $19,000 a year. It's not taxable to them. It is not deductible to me. Okay? That's a gift. So I have a grandson and his wife that bought a house. I gave them money for the down payment. I'd rather give them money now than them get it after I die. Okay? I gave money to him. I gave money to her. It went towards the down payment of the house. I gave them cash. I did not give them stock. If you give stocks to your children, then if they sell the stock, the cost basis of the stock is your cost basis. If my grandkids or my kids inherit a stock when I die, and I don't have time to talk about death except in a couple of minutes, then the Apple stock or this AI stock that I bought down here, it gets what we call a stepped up basis for when I die, for the fair market value of when I die. So a lot of the stocks that I own, I'm just leaving, and it's better for them to inherit them with what we call a stepped up basis. Okay? And so you can gift stocks to your children or not. Now, I have another client, and this has to do with what we call tax planning. They became a client when they were trying to figure out how they were going to manage their taxes and their money. And so they had one daughter, and they decided they were going to carry the mortgage on her house as what we call a seller financed mortgage. And we're doing that. Okay? They hold the mortgage, they pay the taxes, she pays them interest, the interest is income to them, she can deduct the interest. Okay? We started to look at what their son was building a house in Lamont, and they were going to do the same thing. They happened to be very probably lucky and smart. They bought a lot of Apple stock here, and it was worth here. And I said to them, why don't you just sell Apple stock, give the money to your son, pay the tax, the long-term capital gains rate is pretty low considering, and then he'll never have a mortgage. How wonderful is that? He sold his old house. They were going to give him the balance of the money. They're paying, 23% in tax. They're going to get IRMA for 1 year. And it was a brilliant idea. They paid the tax. They gave the kid the money. Okay, he's never going to have a mortgage, and they're going to get rid of the mortgage for their daughter. So again, they paid the tax, but we ran the numbers to see what the tax liability was. Okay, so they would know up front which way was better. Were they better off holding a mortgage? Were they better off gifting the stocks, which, then when the kids have to sell them, they have to pay a huge amount of tax. They paid the tax. So that's what happens with stocks. And again, the good news is that there is a stepped up basis when you die on the stocks. Okay, I think that answers most of those questions. Let me just see. All right, I have a couple of other things I think I want to tell you. Hold on. Let me just look. Oh, I know the last thing, and this is important. Hopefully I won't run over, so stay here. I do want to tell you about a thing called IP PIN and about the IRS online accounts. What in heaven's name is a thing called IP PIN? That's called an identity protection PIN. There is a place and if, God forbid, you have identity theft from the IRS, they will require you to have an identity protection PIN. And if there are two of you, they will require both of you to have an identity protection PIN. You have to put it in there so they know the tax return is yours and not somebody else's, because there's been a huge amount of identity. If you wait, which I strongly recommend most people do, until you get your final 1099s from your investment account, somebody else that steals your identity files early under your social security number. And when you file, then you get a reject, or I get, or you get a reject notice that says somebody's already filed under your social security number. That's identity theft. Okay? The way to protect yourself from that is to get what's called an IP pin. Once you get an IP pin, you have to get one every single year, and some people feel safer about getting them. Okay? So that if I have a client that either has to get one or chooses to get one, you have to go online and get a new one each year. You can get one for one of you. I strongly recommend you get one for both of you. If you have a problem, even with your credit card, which lots of us do now, okay, I recommend you get an IP pin. I will give you an example of a problem we haven't totally solved yet. So often when I have clients, I inherit. My client married a very lovely, lovely doctor in Evanston, and I inherited his two children. Okay. And so I did both of their tax returns. And they both are actually, they're twins, I think. One of them graduated from college and got a job in New York. I did his tax return for him. Okay. And we send every single tax return that goes out of my office. If Beth isn't delivering it, we send, or you picking it up, we send it out Federal Express with a tracking number that we send you, so that you know when it's coming and we know when it's been delivered. This son lived in an apartment in New York City that didn't have a doorman. He didn't open up his email. A month later, the FedEx package was opened. Okay? He blamed us. It wasn't our fault. We sent him an email with the tracking number. And we offered, as good people that we are, to pay for what we call LifeLock for a year for him, okay, so that he would be protected. I told his father and him that he had to get an IP pin. That was protection for him and protection for me. He never signed up for LifeLock. I just emailed his father last week. Okay, I offered to pay for him for a year. Okay, but an IP pin is a very important thing, okay, to protect yourself against identity theft. Okay, now, one of the other things, and this is probably the last thing I want to tell you, this is probably the worst mess I've ever seen. In Illinois, you can set up an account. You can pay your estimated account. You just have to put in once. You have to put in your driver's license. They put online and they give you what's called a PIN number. You write it down, you save it in someplace safe in your tax files, and you have it forever. In order for you to get an IRS account, you have to go through a system that's called ID.me. It is a pain in the you-know-what. Okay, you go on the website, you have to do some kind of face recognition and give them your driver's license and maybe your passport and all sorts of stuff, but they really want you to have an IRS account. Okay, it's called ID.me. If you are my client, like the one I told you that I found out they didn't pay their third quarter estimate, okay, I can go in. I suppose I'm not supposed to, but I can go in and I can check your Illinois estimated. I can put in your social security number. I can put in your first 4 letters of your last name, and it tells you, and it can tell me what you've actually paid and what date you've paid it. I cannot do that from the IRS. Okay? It is a good idea if you can get an IRS account with an ID me number that you can check to make sure everything's okay. It is a good idea. It's not hard to do. We do it with clients all the time because it's important for them to be able to get in. My last thing that I want to tell you, that if you wind up getting letters, again, without anything, if I need to work with you and I need to find out where a problem is, I send you what's called a power of attorney form. I have to either upload it online, which I can do. I have several credentials. I have what's called an enrolled agent, which means once I get a power of attorney, I can talk to the IRS on your behalf without you there. I also have a CAF number, which is called a central authorization file number. What that means is with a client with a problem, okay, after I either faxed them or uploaded my power of attorney, for the years that I'm authorized for, I have an IRS mailbox. They will send me every tax document that you have or should have had and that they have on file for you under your Social Security number. It's called my SOAR mailbox, and I can go in and download those. I cannot go in and find out without a power of attorney what your estimated taxes were that you paid. So again, these are the kinds of things that if I have to leave you with anything, we live in an online age. I am not only asking you, I am begging you to make sure that you have all your tax documents before you start your tax return. Many of them are initial documents, and the final ones come in March. Part of the reason I can do this on February 4th is because I am not busy yet. I don't get busy until probably at least the third week in February because people don't have all their stuff. And we make sure that you have everything because otherwise you get a letter and who do they blame? They blame me. Okay? And I can only, as a tax professional, I am responsible, and I'll say this again, for what you give me. You are responsible for what is on your tax return. I think the last thing I want to say to you, and as I said, I don't know if I'm looking for more clients or not, but one of the things, and this happened to somebody that's new, he had his tax return done by a big accounting firm. And he wanted somebody who would explain it to him, which is how we work, because not only am I a tax person, but as I told you, I was a teacher and a professor. And he sent me by email 80 pages of his old tax return. Do you know where it was prepared? It was prepared by somebody in India. So many times when you go to a tax person, they give you an input sheet, or they call it an organizer. You fill it out. They give it to somebody in their back office. They put in what you gave them. Somebody like me looks at it briefly, and you get it back. Part of the reason that I'm still in business, and hopefully my clients love me and I love them, is because I will not let you get away without understanding where every single number on your tax return came from. Whether I do it in person, whether I do it on the phone, or whether I do it in Zoom and the tax return is right there and I can share my screen, and then you can ask me questions and I can look at the kinds of questions you've been asking me. What if I did this? What if I did that? What does it mean if I gave away this? And I tell you, well, you have to fill out a 709, but there's no tax. Okay? And so again, whether you do it yourself or whether you hire somebody, this is going to be what I have to call an incredibly challenging year for all of us. And if you hear me screaming from Chicago to Woodridge, you'll know that the IRS is giving me problems. I wish you well during tax season. If you have questions that I haven't answered, or there's something generic that you want questions about, or there was this other question about, I don't remember where it is, but if you email me, my email is Judi, Judi, at StraussTax.com. If it's a generic question like the one that I probably forgot, but I'll remember, I'll be happy to answer it for you. If it's something specific, I can't. But as I said, if you become a client, you'll either get me on the phone or Beth Austin, who is my office manager, and you can see her picture on my website, which is www.strausstax.com. I want to thank Savannah and all of you for being here, and happy couple days after Groundhog's Day. Stay warm.
Perfect. Thank you so much, Judi. I really appreciate it. That was really informative. So thank you for being here.
You're welcome. Bye, everybody.
Yep. Have a good night, everyone.